Welcome to Capitalize Your Finances, the podcast that's your ultimate guide to mastering personal finances and unlocking the secrets of entrepreneurship. Each week, we dive into the world of personal finance and business development and have fascinating conversations with industry experts, seasoned entrepreneurs, and thought leaders who share their insights, strategies, and stories to help you get ahead in life. Whether you're a seasoned entrepreneur looking to scale your business or someone just starting out on your financial path, this podcast is your go-to resource for inspiration and actionable insights.
Welcome back to Capitalize Your Finances. As always, I am your host, Christopher A. Paniotu, certified financial planning professional, the Cap and Capitalize. And today, we are actually starting off with a new segment of our show, the free weekly financial tip. And today's weekly tip coming to you is do not overcomplicate your financial situation. I see too many people make ungodly complex financial decisions, and more often than not, it is to their detriment. This is actually a great segue into today's episode because some of the greatest investors of all time have gotten to where they are by only investing in sometimes 1, 2, 3, 4 investments. It does not need to be complex, so do not overcomplicate your finances. Now that we've got that new weekly tip out of the way, it is time for today's episode, which is rather timely and unique. I'm going to be reviewing Warren Buffett's Berkshire Hathaway annual shareholder letter. Now, as you can see, for those of you that are watching the show, I print this sucker out and I read it. I'm old school, okay, when it comes to this stuff. I printed this thing out fresh on the Saturday that it came out. When my girls were still asleep, I read it cover to cover, did the good old highlighting, and as I do every year. And I think it's valuable to go through it. We're not going to go line by line, but I want to note some of the most valuable takes that I took away from this shareholder letter, and more importantly, how it can impact you in the most positive way. Now, right off the bat, Warren Buffett's business partner, Charlie Munger, did pass away last year. He was 33 days away from his 100th birthday. And one of the things I can take away and give back to you all as kind of a token that you need to take with you for the rest of your life is if you've got someone that is extremely important in your life, whether it be personal or professional, especially after they're gone, remind people how great they were. Warren Buffett was very quick when it came to describing his well, I mean, it was a dedication, but you also got to understand, I mean, it is a shareholder letter. So you got to kind of get to the crux of the matter. But it was short, it was sweet, it was to the point, and I really think it embellished everything that Charlie Munger was, not only to Berkshire Hathaway, but to just investment professionals in general. Now, you know, there were a couple things that I found incredibly intriguing. And again, I like I said at the beginning, I'm not going to go line by line, but I'm going to go through some of the things that I highlighted that I thought were the most valuable. So one of the things that Warren Buffett finds unique is the concept of earnings. And earnings is basically profit for those of you that are not aware of the business lingo. And so when you're looking at an income statement or a cash flow statement and you look at earnings, that's profit. That's whatever's left over. Now, one thing that he said was, quote, at Berkshire, our view is that earnings, and I'm using quotes for those of you that aren't watching, should be a sensible concept that Bertie, who's his sister, will find somewhat useful, but only as a starting point in evaluating a business. Accordingly, Berkshire also reports to Bertie, his sister, and you what we call operating earnings. Now, the reason why this is really critical, it's not for the specifics of what most people are going to nerd out about, but if you're going to go and analyze a business, really know what the heck you're reading. In his example, there's a difference between earnings, which is profit, and then operating earnings, which is what the company actually profited every year. And again, not to get into the weeds of it, but earnings as a whole can include things that are not realized. So if you haven't sold an investment, That's technically considered a gain under the new tax codes as of 2018. And same thing for losses, even if you haven't sold anything. So I thought that was pretty fascinating. Now, I can tell you one thing that struck me, it actually struck me as rather peculiar, was how he, and it's not the fact that he's old and he's forgetting. I mean, sure, as you get older, you do maybe slip up and you say some things that you shouldn't, or you say, and you repeat things that have been repeated maybe one too many times. But even with that, it was interesting to me when he wrote how much he needed to emphasize the types of businesses that people need to own. And again, at Berkshire, we particularly favor the rare enterprise that can deploy additional capital at high returns in the future. Owning only one of these companies and simply sitting tight can deliver wealth almost beyond measure. And again, the free advice that I gave at the beginning, the free weekly tip at the beginning, describes just that. Warren Buffett in Berkshire Hathaway have made hundreds, maybe thousands of investments over Warren's 93 or 94 years on Earth. Last year, he actually wrote about this. His entire career could be summed up in 12 investments. 12. That's crazy to most people. It's not to me, because I know mathematically all you need is a couple great investments and you are going to be great. But you have to understand how to value these investments. And once you do have that conviction and you truly understand these businesses, the next thing that you need to understand is sit tight and let the businesses do what they need to do and ignore the pundits, which is something he talks about later on in this in the shareholder letter. Ignore the pundits and ignore the noise and have the conviction that you actually know the business or businesses that you have invested in. Don't buy it because someone else told you it was a good idea. And that even includes Warren Buffett himself. A lot of people will go and just try to mirror what Warren Buffett has done at Berkshire Hathaway. So for example, if a quarterly report came out that he bought more Coca-Cola, a lot of people would just simply copy that and buy more Coca-Cola. The reason why that's such an issue is, I don't know if you may or may not know this, but Warren Buffett is probably worth a little bit more than you that are listening right now. And because of that, his universe of companies that he can buy with Berkshire's amount of cash, it's really small. He said multiple times over the years, I wish I had less money to invest, because then the window in the universe of companies that I could invest in, it's greatly increased, which means my opportunity is infinitely more vast than it is today. So don't just copy people to, well, frankly, just to copy them. The exception to that would be if you look at, and I'm just going to use Warren Buffett and I'm going to use Coca-Cola as another example. If he went and bought it last quarter and that came out in the report, I would agree with looking back and going, okay, go analyze Coca-Cola and ask yourself, what did Warren Buffett see that most people didn't see? Or another thing you could say is, what did Warren Buffett see that I can use for myself for other companies that I'm looking at down the road? I think that's really valuable, okay? Now, this was not an investment topic that he wrote about, but he wrote, quote, sincerity and empathy can easily be faked. And it was interesting because he's talking about the difference between finding someone with, true sincerity, upstanding principles, just overall fantastic people, and then those that mask it. They say that they're all these things, but eventually you're going to figure out who these people really are. And that gets to be, that's an investment level 501 strategy. Because a lot of people focus on the numbers when it comes to companies and investing. But I can tell you right now, analyzing and in some cases interviewing the best investors in the world, their edge is understanding the business, the quality of the people running the businesses, and then the financial side of things. Most people focus solely on the price and then they go from there. And unfortunately, when the quality is bad, the price will eventually reflect it. It may be a while till that actually happens, but eventually it happens, and it happens all the time. Versus if you understand how to read the difference between the great people out there and those that are crap, but they mask themselves as greatness, that's where you're going to add a tremendous amount of value to, frankly, your net worth and your personal net worth, meaning like your overall health. Now, one thing that was kind of an alarm bell, and by no means is this direct investment advice, but he said, and this was fascinating to me, we have no possibility of eye-popping performance. All in all, we have no possibility of eye-popping performance. One of the things I took away from that, and it was a great reminder for me, if you're talking to someone that, and let's say you're interviewing, whether it's an investment advisor, a financial planner, just an asset manager, a hedge fund manager, if you're, just worth gobs of money, honesty it's the greatest asset that anyone is going to have when it comes to this type of conversation. And here's a guy who, for all practical purposes in the world of investing, is the GOAT. He is the greatest of all time. There probably is never going to be another Warren Buffett. In fact, I can almost guarantee that. Someone has to start investing like very seriously at 10 and become obsessed with it and then do it for 84 years and just kick the snot out of everyone basically every year forever. I'm not saying that can't happen, but like the odds are pretty slim. I started investing when I was 10. I'm never going to be Warren Buffett. In many cases, I don't want to be Warren Buffett, but from an investment standpoint, it just, I got to start revving the engine. Let's just put it to you that way. Okay. But here's a guy with all those accolades saying, look, in the next couple years, you can't guarantee it, but I really don't see this eye-popping performance. And that also should tell you that the wisest investor in the world is being very prudent and patient, selective, and observant with what's going on. There aren't a ton of major moves that he is or has decided to make and is planning on making in the near future. And he says that very black and white. He goes on to talk about how, and he further explained the return standpoint for the future. So Berkshire's ability to immediately respond to market seizures with both huge sums and certainty of performance may offer us an occasional large-scale opportunity. The stock market is massively larger than it was in our early years. Today's active participants are neither more emotionally stable nor better taught than I was when I was in school. For whatever reasons, markets now exhibit far more casino-like behavior than they did when I was young. The casino now resides in many homes and daily tempts the occupants. So this kind of further got my mind thinking, going, okay, the greatest of all time, I'm not saying he's sitting on the sidelines, because he's not. A lot of people go, oh, well, he's just not investing anything right now. No, the guy has Berkshire Hathaway, in his grasp, And I think it just passed $1 trillion worth. Now, granted, the guy has like $150 billion of cash sitting in the bank, which on an absolute basis, yeah, that's a boatload of money. But when it comes to relatively of his portfolio, and not his, but Berkshire Hathaway's portfolio, it's like 10 to 15% of it in cash. And again, because of the size of the company, he can't just go out and just buy a company that he thinks is going to do really well for the heck of it. Because even if that's the case, it's not going to move his needle. Like, let's say he bought a company, hypothetically, for $1 million, and it went up 100x. Well, great, he's got $100 million. I'm not saying that's not a big jump and not a lot of money, but when you're talking about how big of a company Berkshire Hathaway is, that is a drop in the bucket. Like that will not move shareholders' needles at all. But I bring this up because a lot of people read this as a surface level recommendation of you just need to wait on the sidelines. And then you get into the danger of, oh, you're going to go and time the market. And now's the time to get in because Warren Buffett is saying, oh, I find all this opportunity. That's not the case. He is just telling people on behalf of the shareholders, it's really hard right now, given the size of the company, to find opportunities to materially move the needle. So therefore, right now, we're not necessarily getting rid of a ton of stuff, but all in all, we are going to be prudently patient. And prudent and patience are two of the things that I preach the most on this show. And to the veterans that have listened in really since the beginning, it is a broken record. I will continue to repeat that until I am blue in the face. Now, it wasn't all like negative. I mean, there were actually a lot of positives. And I could actually say that this shareholder letter was all in all really balanced, which is what Warren Buffett tries to do every year. You know, his thing is, and he says this all the time, never risk permanent loss of capital. Now, he's not saying you can't lose money, okay? Anyone that invests in a long-term investment has to understand that there is a risk on that investment. That is business 101. But if you can do as much as you can to mitigate that risk, obviously that's going to be a big deal. And he makes a huge compliment on the American tailwind because, you know, I'm really fortunate to live in the United States. And frankly, this country has had a pretty good run when it comes to economics. And that's through the Great Depression. That's through 2 world wars. That's through Cold Wars. That's through the dot-com burst, the Great Recession. You can go back when interest rates were just sky high. The 1974-1975 crash, which was just egregiously awful. I mean, we've gotten through all of that, and our economy somehow, some way, manages to figure it out. And he gives a huge testament to that. And obviously the power of compound interest. And if you make a couple of good decisions in your lifetime and you avoid the serious mistakes, you cannot help but be successful. There's a lot of repeating that he has during this during his annual shareholder letter. And a lot of people, again, they're going to use that as an excuse of, okay, he's getting old. Maybe he's trying to really just hit you in the head with it. Now, one thing I thought was really fascinating, this has no investment advice whatsoever, but it's just particularly intriguing to me. When economic upsets occur, as they will, Berkshire's goal will be to function as an asset to the country, just as it was in a very minor way in 2008 and 9, and to help extinguish the financial fire rather than to be among the many companies that inadvertently or otherwise ignited the conflagration. It's late in the day. But his thing is, I'm trying to build this thing to last. And I think this is really valuable to those of you that are thinking about getting into the world of asset management or investing in general, because a lot of people get into this business for the wrong reasons. And good intentions, but the wrong reasons. They go, I'm getting into this because I want to make a lot of money. Well, guess what? If you do right by every single one of your clients or your investors, by definition, you should have that result. But Warren's taken it a step further to think that, hey, like Berkshire Hathaway, it's much more than just an investment. It is a juggernaut of a company that, I mean, to the point where if the United States ever needed our help, we could, in theory, come in and assist with that. I actually think that that's a pretty cool way to think about it, and it's kind of next level. It got me fired up because I'm like, okay, how can I next level my business or my thought with my money or my thought with Stephanie and my portfolio? And I think that's really valuable for you to do the same. Now, there's a term that he mentioned, and I'm smiling because I cannot stand when companies tout this metric, EBITDA. It is a band measurement at Berkshire. And so for those of you that are wondering, like, what the heck is that, right? It's earnings before interest, tax, depreciation, and amortization. So basically, before any of the major expenses are taken out in a company, what is your profit before all of that? And I get that there's some value out there for smaller companies. And if you're trying to sell your company, because I've had some merger and acquisition specialists on my show, and I've gone on their show, and we've talked. Like, I get it, but at the end of the day, I'm a simple dude. Like, if a company's not profiting, there's a problem. Now, there's a difference between if they're reinvesting into the business to show the profit being really low, and it's very strategic and it's very intentional, versus you got a company that's touting EBITDA, but then when you actually look at the company, it's crap. Like, it's a garbage company. And I think that is tremendously valuable for you all listening, is if you are planning on either hiring an investment manager or a financial planner, or if you're going to do it yourself, really analyze what matters. And then if you're going to interview a financial planner, ask them how they value or their team values companies. And really get into the weeds of that. And if it's just surface level Wall Street gunk, find someone else. Because if you hire gunk, you're going to get gunk. That's just how it is. Now, one thing that struck me massively is, Berkshire Hathaway has $150 billion in cash. I think it's safe to say they're going to be good for a while if they had a couple bad years. But I say that because Warren even wrote, we did not predict the time of an economic paralysis, but we were always prepared for one. If there's one dude out there that could get away with being a little loosey-goosey with his cash, it's probably Warren Buffett and Berkshire Hathaway, because they've got, in some cases, more money than God. But here's a dude who's been doing this for almost 100 years, and he always stays on top of it when it comes to not being foolish with his money. I remember hearing this, I think it was like 6 or 7 years ago, and I didn't believe it, and I laughed about it. Warren Buffett, I think it was like 15 or 20 years ago, actually financed a remodel on his kitchen. and I think that's hilarious because the dude's worth like $100 million, and he took a loan out. And I think the banker asked him, and I would have been stunned too, like, dude, why are you doing this? And it came back to, well, why would I go and just pay all this off when the interest rate is super low and I can take anything extra and reinvest it into further compounding my net worth? You could look at it and say, yeah, that's crazy. You can look and say, okay, maybe he's on the spectrum a little bit when it comes to his money. I look at it as that's the grace of all time, being perpetually prudent with his craft. And maybe you should do the same. One of the things that I get why he wrote it, but I disagree why he hung on to it, was when you're touting your best businesses, I get where he's coming from in the fact that he's saying, look, I invested in Coca-Cola, in American Express back in the day. They've become recognizable names worldwide as their core products are universally accessible to all people, etc. The reason why I don't like this, and it's interesting because in our industry, we're not supposed to give specific investment advice on these shows, which I get it. And I'm actually not a huge compliance fan. And for those of you that know me personally, you know exactly how I feel about that. This is one of the areas where I totally agree with it because Coca-Cola and Amex, I'm just going to use it as an example, that is in Warren Buffett's circle of competence. That may not, and I can actually tell you, there's a lot of you out there, that's not going to be in your circle of competence. But a lot of people go, oh, he says Coca-Cola and Amex, therefore I'm going to go and buy these companies. You also got to understand, he bought these companies in like the 80s and 90s, and he hasn't sold like hardly a penny. And what he's trying to say is you need to go out and find your equivalents of my Coca-Cola and American Express. You know, I'm not throwing Warren under a bus here because, you know, you don't throw the goats under a bus. But that is one of the things that I get really irritated with is when people tout, you know, hey, this has been my best holding. I've held it for all these years, because when you become popular like he has, people look at that in the wrong way. And that's actually when you get hurt. And again, I'm not saying Coke or Amex are good or bad investments. That's not what I'm saying. But what I'm saying is people look at that and then they go, oh, I just need to hop on the bandwagon because they're reading surface level what's going on. And then when that happens, maybe you're buying at an inappropriate price. And that's when you get hurt, because price does become valuable at some point in the game. Eventually, there is such thing as too expensive as a company to buy when it comes to a stock, and that's where you get hurt in the long run. Now, before we move on any further, I'm going to take a quick break. We're going to head off to the commercial and the sponsor of today's show, and then we can come back. I'm going to wrap up the Berkshire Shareholder letter. You're going to want to stick around with it because, frankly, we're going to get into some of the most positives and then some of the things that you need to look out for in the future when it comes to analyzing business. So with that, roll the clip. We'll be right back.
Capitalizers, this episode is sponsored by the best-selling book, Capitalize Your Finances, the how-to framework that takes you from compoundingly clueless to monetarily magnificent. Regardless of where you're at in your financial life, whether you're just beginning to express interest and commitment to your personal finances, at the pinnacle of your career, winding down into retirement, or thinking about your legacy for future generations, this book walks you through every step of the way so you can succeed on your terms and with your own values and passions guiding you. After reading this book, you will officially have Christopher A. Panayotou, the Cap in Capitalize, in your back pocket, guiding you in detail through every step of the way so that you can take charge of your finances, not the other way around. Head on over to Amazon.com today and start capitalizing your finances to the fullest with this incredible book, Capitalize Your Finances, the how-to financial framework that takes you from compoundingly clueless to monetarily magnificent. And now, back to the episode.
Welcome back to the show. Now, while we were on break, I was rereading something that caught my eye that I actually wasn't going to originally bring up. And this indirectly relates to what Warren Buffett talked about in this shareholder letter, but it really was more of a 2020 to 2021 topic that was really big. So during that time, what intrigued a lot of Berkshire shareholders, as well as just investors in general, is Warren Buffett actually went and invested in 5 Japanese companies. Now, you know, in and of itself, that doesn't really mean anything, but we've got to dig deeper because we're not just everyone else, and we're not surface level thinkers here on this show. Japan is in a really unique situation when it comes to their economy. I mean, they have been in a deflationary period forever. Okay. Like you could have like $1 million yen. It's like $10. Like it really doesn't move your needle. And Japan also has a ton of headwinds. Okay, their population is decreasing rapidly. It is much more difficult to open up a business over there. Culturally, there's a lot of things that I'm not saying they're not important, because they are, but they can hold a lot of people back if you are not part of that culture. So to most people, there are a lot of cons that outweigh the pros. And that's why, from an economy standpoint, as a whole, Japan has been pretty tough to invest in. So here comes the greatest of all time. And he goes and invests in 5 companies in Japan. You're going, wait a second, why the heck did he do that? Now, I'm not going to get into the weeds of why exactly he did it, because there's a lot of specifics and you can go down rabbit holes. And frankly, I'm too tired to argue with the pundits at this point. But one thing that was interesting is how he funded the purchase of these companies. So obviously during 2020 and 2021, interest rates were low in the United States, but they were stupid low in Japan, to the point where good old Warren, he did his analysis and he said, hey, I'm going to take a loan through Japan, and I'm going to take this loan at basically next to 0% interest, and I'm going to go and buy these companies. Now, he did a lot of the diligence and analysis, and what was fascinating about that is he realized that these 5 companies, which are extremely profitable — I'm not going to name them specifically because then that gets confused with investment advice. That's not where I'm going with this. After he did the analysis, he understood that after a couple of years, if they increased their dividends, because in Japan, and I believe it's a cultural thing, but don't quote me on this, they're all about the income. They're all about giving that money back. And it's not that they don't reinvest it back into the businesses, but a lot of these businesses are older too. And so they are super obsessed with the shareholder value, which is a huge positive. But in their mind, it's much more, okay, because of the conservatism of their economic minds, they would much rather give that profit back to shareholders for them to go and invest however they want to, versus reinvest back into the business, because there's frankly too much risk on that. So Warren basically discovered, oh my gosh, if I go and invest in these companies with this 0% loan, I could basically pay that loan off with the dividends in a couple of years if they continue to raise their dividends accordingly. And that's what happened. So you could argue his rate of return on that investment was like infinity, because he basically took that loan and he went and bought those companies. In a couple of years, the income from those investments, not touching the principal, paid off the loans. And so he basically got stock for free, which actually points to the whole concept that we talk about in our masterclass and in my book, Capitalize Your Debt and Capitalize the Spread, right? He took an interest rate that was basically 0. He earned whatever he earned. That was his rate of return. And I think that's something that's really valuable that people need to be reminded of, is debt is not always bad. You know, you listen to the Dave Ramseys out there where, oh my gosh, debt is bad. You shouldn't go into debt. If you go into debt, you are literally the devil. Well, joke's on you, because here comes Warren Buffett. He went into debt, quote unquote, and he basically, with the free money, bought these companies, paid all of it off, and I mean, his return skyrocketed. So the moral of that story is, debt is not your enemy. It is definitely not always going to be your friend, but use it to your advantage, because if you use it prudently, the proof's in the pudding, your return could skyrocket substantially. Now, the scorecard in 2023 is something that Warren always likes to share. And it's really just like a 50,000-foot view on how the main parts of the company did at Berkshire, which, if you know Berkshire Hathaway, you know these industries. But if you're not familiar, it's really broken down into about 5 or 6 different industries. There's insurance underwriting. There's insurance like investment income, railroads, utilities and energy, and then other business and miscellaneous items, which is their largest number. Okay. And it was kind of a fascinating breakdown, and he goes through it ad nauseum. But one of the things that was really interesting was how much higher Berkshire Hathaway's investment income was. And, Warren is pretty old school. I mean, yeah, because he's like almost 100 years old. But in the fact that he likes to keep things pretty simple. He likes to have the money. He always likes to keep $20 billion in cash. And we're talking bone dry cash. It's not earning diddly poo. That is what it is. Okay. Anything above and beyond that, he actually likes to ladder government bonds. And he keeps it pretty simple. Now, occasionally he'll find some rare opportunity where he'll maybe buy a corporate bond or a preferred stock, but let's not get ahead of ourselves with that because it gets too complex. He likes to keep some safe money laddered. And the reason why his investment income was so much higher was because interest rates between really 2022 and 2023, they skyrocketed. I mean, from 2022, they skyrocketed. In 2023, they kind of stayed as high as they were and then increased slightly. And what was kind of cool with that is it hedged a lot of his investments that, didn't necessarily grow as much from a percentage standpoint. But then in some cases, he had a couple that had some setbacks. Now, he goes through, the pros and cons of all of that in why you should either be cautious or optimistic. That's not what I'm getting at. What I'm getting at is you need to understand that even though diversification is grotesquely overblown, just like what I said at the beginning of the show, there comes a point where some diversification, or let me rephrase that, just enough diversification is extremely valuable. So, little history lesson, when 2008 came around, Berkshire Hathaway had a pretty good chunk of their portfolio, relatively speaking, in laddered bonds. No different than what he's always done. And guess what happened? There were some opportunities that were so blaringly brilliant where he looked at it going, you know what? This bond doesn't come due in 6 months, but I'm going to take whatever return I get, in some cases maybe a little bit of a loss, because the gain that I have, the opportunity cost, which is a huge topic that you need to understand, of taking that money in the bond and investing it in another company, I mean, that company is going to, more likely than not, pay for that loss and then some. It's a no-brainer. The reason why I bring this up is it doesn't matter where you are when it comes to your financial plan, whether you're accumulating your net worth, you're about to retire, or you have retired. Cash can be an extremely valuable tool, and more often than not, it is the most valuable when, unfortunately, people don't have it in the first place. And that's where, Warren Buffett is not a financial planner, and he tells everyone, I do not hold myself out as that. But indirectly, he's kind of saying the same thing we've said on our show for years. You need to have your prudent emergency fund set aside. And then in some cases, if you have retired or are about to retire, it is okay, when in doubt, to have a little bit more safe money on the side as opposed to not. Again, if your plan is prudently allocated, that's where you can earn a substantial return for you, your family, in future generations. And, a lot of people think that when you're investing and you find a company, or you find a real estate investment trust or a private equity investment or whatever. You just take that lump sum that you have, you go all in, you just sit and wait. One of the things that stuck out to me was, given Berkshire's present size, this is a direct quote, building positions through open market purchases takes a lot of patience and an extended period of quote unquote friendly prices. So one of the biggest mistakes I see a lot of people make is, like I said, they go all in immediately. Now, I'm not against that when it comes to running your business or, professionally managing your business if you run a business or if you're an executive. But when it comes to building a holding within your portfolio, it's okay to not necessarily go all in. It's okay to build a position, because as you're building a position, the more you build it, the more you learn about the company. And the more you learn about the company, the more you're going to understand how much you should go and allocate to that company relative to the other opportunities or other companies that you own. Now, Charlie Munger, when he passed away, he had Berkshire Hathaway stock, Costco. He had a little bit of the Daily Journal. He had some money with Lee Lu, who's local from Seattle. And then he had a couple apartment buildings. Now, you could argue Berkshire Hathaway has, dozens of companies, which it does. So you could say that that's where his diversification came from. But he was adamant when he said, look, I got five investments, basically. And I kept it super simple. And that's really all I needed. And I can tell you that when Charlie was investing in companies, and his joke was, or the joke about him that Warren always says is, he's the abominable no man. He would say no to like 99.99999% of all investment opportunities that came his way. But the ones that he said yes to, he almost always added over time. I mean, Berkshire Hathaway was his largest holding, and he added to Berkshire Hathaway like over his lifetime, which, I mean, talk about the definition of extreme patience. So I guess what I'm saying there is, from the takeaway that you can really pass along is, the most successful people when it comes to money are uberly patient when it comes to deploying their money. And that's okay. And you should ask your financial advisor or planner, if you have one, if they feel the same way. And have them explain it. And if they can't explain that, find another one, because you get one shot at this life. And when in doubt, it is okay to be patient. And, Warren Buffett talks about some of his major investments, like the railroad, like BNSF Railroad. This was kind of fascinating to me because, railroads, they're not going anywhere. It's going to be pretty hard to break into that market. Like, my brother and I aren't just going to wake up one day and go, hey, Ty, you know what? We're going to go build the next railroad that's going to take over, or that's going to take on BNSF in all the railroads in the country. Like, it probably isn't going to happen. No offense to me and my brother. And a lot of people, and this is actually like an investment 501 topic. They think, okay, is it in my circle of competence? Is there barrier to entry? Is it a market that is going to be pretty tough to replicate? Like, oh my gosh, there's hardly any risks with that. And it was fascinating how he was describing, in my opinion, how, it's not like the railroads are going away, but how capital intensive these companies are. And the reason why I think this is valuable is, if Berkshire Hathaway was starting today, I have no doubt that Grandpa Warren would be allocating his shareholders' money totally different than how it is today. Now, granted, he's owned BNSF Railroad for, decades at this point. So it's pretty hard to sell a railroad. But one thing that I found was interesting, because he loves layering in these little nuggets of wisdom in these clues, is really understand how much money it takes to make these companies work. Just because everything that I said earlier is about the barrier to entry and competition and the loyal following and the moat of what we talked about in past episodes. Just because all those things are there, that doesn't mean that's where you stop when it comes to analyzing investments. You've constantly got to be digging deeper and deeper and deeper. And just when you think you've gone, deep enough, you're probably scratching the surface when it comes to analyzing investments. And, on the flip side, of course, he talks about, some of the big winners. Again, I'm not going to get into those because, frankly, that comes across as investment advice, and I don't want you to have inappropriate thoughts in your mind when it comes to making the wrong decisions. But if I could sum up this annual shareholder letter in the best way possible, it actually has nothing to do with investing. It has to do with what sort of people to avoid. And, as we're wrapping this guy up, I think that's going to be kind of the best concluding topic of discussion. It's one thing to make a lot of money. And a lot of money, that's a relative term, because a lot to someone is maybe minimal to another. I can tell you that the best investors out there have the highest returns, not because of their quantitative understanding of companies. It's their qualitative understanding of the businesses themselves, the people that run the businesses, but then outside of that, it's the people that they surround themselves with, like in and outside of professionalism. And that would be, frankly, my biggest takeaway I can give to you all listening in. I really don't care where someone is from or their relationship that they have with you. If someone gives you a reason, especially a series of reasons, to no longer be in your life, you should not have them in your life. And I can tell you, like toxic people, that is the greatest cancer of anyone's lifetime. And they will take years off your life. And that was a theme that I felt indirectly Warren was trying to get at with people. Because let's face it, the dude is on the 1 yard line and not at the start of the game. Okay? Like, if he gets one more yard, he's meeting Jesus. Like, he's not going to be around for that much longer. And I felt like he's really trying to instill to people, look, yes, I've done great on the investment side of things, business side, mergers, acquisition, arbitrage, all the fun stuff that us nerds like to get into. But it's about the people. And it's about understanding that the reason why he has been around as long as he has, or Charlie Munger was alive as long as he was, they didn't have those toxic people in their lives. And you ask a lot of these investment professionals that have surrounded themselves with Warren and Charlie and look up to them as mentors directly, they said, yeah, it's interesting. The one thing that I noticed for both of them was they were always surrounded by the utmost quality of humans. So do that. If you're not surrounding yourself with the utmost quality of humans, you need to get those people in your life. And then if there are people in your life that, and I'm saying if they don't meet one criteria that is up to your standards, let them go. Don't wish ill will. Don't wish anything negative. There's a lot of people that are not in my life that were in my life for years. And maybe it's due to past experiences I've had in my life, whether it's trauma, maybe it's how I analyze companies, because I could own a company for 10 years and then if they mess up, gone, sold. I don't even think about it. No different than people, because I can tell you, if there is a great person in your life and you know they're a great person in your life and you keep them around, they're going to add an immense return on your emotional investment. There are great people out there that they may just not be great for you. And that's okay. There is nothing that says you are going to lose out on anything in life by not having those people. But it's the ones that do not meet your standards, that are extremely negative. They're toxic. They are cancers. They are a drag to your life, in your family's life, in your friend's life, in your business's life. For every moment that you are around them, you are losing seconds, minutes, days, months. You are losing years on the one life that you have. And that's where we're going to conclude today's episode on the review of Warren Buffett's annual shareholder letter through Berkshire Hathaway. Thanks for watching. As always, thank you for joining me today. If you have questions about today's episode or any personal finance questions, please reach out to me at Cap and Capitalize on Instagram, Chris at capitalizeyourfinances.com, or via our website, capitalizepodcast.com. If you want more Capitalize Your Finances content, head on over to capitalizepodcast.com and check out our blog, free resources, book, and online course. As always, I'm your host, Christopher Paniotu, Certified Financial Planning Professional, the Cap and Capitalize. And until next time, keep capitalizing.
The information provided should not be considered specific tax, legal, or investment advice and is not specific to any individual's personal circumstances. You should always seek counsel of the appropriate advisor prior to making any investment decision. All investments are subject to risk, including the loss of principal. This material is gathered from sources believed to be reliable. However, its accuracy cannot be guaranteed. This material should not be considered a solicitation of an offer to sell or buy any specific security or offering. Investors should consult a financial professional to determine whether risks associated with an investment in the shares are compatible. Examples cited are hypothetical, are for illustrative purposes only, are not guaranteed, and subject to potential federal and state law amendments. There's no guarantee that you will achieve the results discussed or illustrated. Diversification strategies do not ensure a profit and cannot protect against losses in a declining market. You should carefully consider the investment objectives, risks, charges, and expenses of a non-traded REIT before investing. The prospectus, which contains this and other important information, can be obtained from your financial advisor. You should read it carefully before investing or sending money. It is important to keep in mind that investments in fixed income products are subject to liquidity, interest rate, financial, inflation risks, and special tax liabilities. Interest may be subject to the alternative minimum tax. Preferred stocks are sensitive to interest rates. The share price generally falls as prevailing interest rates increase. Christopher Paniotu is a registered representative with and securities and advisory services offered through LPL Financial, a registered investment advisor and member FINRA SIPC. The investment professionals are affiliated with LPL Financial and are conducting business using the name Capitalize Your Finances, a separate entity from LPL Financial. Warren Buffett and any other individual or company mentioned in this podcast are not affiliated with Capitalize Your Finances or LPL Financial.